Welcome to an ACY Securities webinar. My name is Alistair Schultz and I am the Chief Market Analyst for ACY Securities. And my history has been pretty diverse over the years. I've worked in both brokers and investment funds, including on the floor of New York in different trading environments, as well as the floors of Wall Street in the pit. So I do have a little bit behind me, about 15 years in total these days. And tonight's webinar is really going over some basic money management principles to start off with. As the webinar progresses, I will be moving into some strategies behind money management, and they will get a little bit more sophisticated quite quickly. But if you do have any questions along the way, you are able to email me, especially if you've seen some of my videos, you may already be aware. But my email address is talktoal with the number 2 at acy.com. So if you don't get your question answered tonight, then feel free to shoot me an email. I'll quite happily answer them as best as I can. And the strategies that I'm covering tonight and the way that we control money management sort of in the professional world does vary, and there are plenty of other options that are available to you. But I like to show some of these tonight to give you an idea of just a few of the different ways that you can control your trades, and more importantly, what you can do about losses. So to get started with, obviously the first thing I have to cover is a risk warning and a bit of a disclosure about foreign exchange and derivatives and about them being high risk. I'm sure many of you have already read this sort of stuff before. So make sure that you understand the risks behind trading and that your risk tolerance and trading experience quantifies for your ability to trade, and that the objectives match to what your financial situation or needs might be. So moving on from the risk disclosure, if you want to read this, there is one available in your PDF statements for any of the products that we service, and we can sort of get underway. Now, money management is perhaps one of the most important aspects of trading, even more important than your entry and exit points. Understandably, money management involves subjects that sort of need to be understood in their own metrics or in isolation, and how they sort of work together to form a cohesive money management system. So some of the things that I usually try and cover, and I will try and cover today, is sort of basic performance statistics, including the mathematics that are behind them, trade sizing and how you can actually apply it with calculations, stop losses, and a variety of different ways that you can take some of the thinking process out of where you might get in or get out of a trade, and when you might use different types of strategy methods that might involve different strategies or entries completely on their own. So the first thing we're sort of going to consider is the idea that performance comes as a statistic. And of those performances, we have to consider the idea of the math that's behind it. Now, involved in trading, there is always a lot of math, and there's no exception to that. So the first thing I'm actually going to cover with you a bit is about win rates. Whoops, sorry, I've just gone to the wrong one there. There we go. So when describing trade performance, the win rate is commonly a quoted statistic. You'll usually see it with investment funds or perhaps in reporting where they print out certain different details about their trade history. It's an important figure, and it compares the number of winning trades to the number of losing trades expressed as a percentage point. So in this instance here, we have the number of winning trades over the total number of trades, and then you times it by 100%. And this will give you your percentage for it. So for example, a win rate of 60% tells us that at all trades that were taken, 60% were winners. It's a really simple statistic, but it does have limitations. So on its own, it doesn't really reveal whether a trader's performance is successful. For example, if it is possible to have a win rate of 90%, but only break even or even lose money. And this would only occur if the actual size of the win was small, but the size of the losses were large. For a win rate to really have any value, it needs to be coupled with a risk-reward ratio. Sorry, one moment. I'm just about to cough. Pardon me, that's a bit better. So in order to have it to be, of value, it needs to be coupled with this risk-reward ratio. And this sort of helps you to predict whether the trade performance can lead to a profit. Now, you might use these in conjunction when you're doing your own system or back testing, but if you are planning on you giving your money for someone to invest for you, then you need to be able to understand what the metrics are behind them. Now, there are a number of other ratios that are used, such as asset ratios, everything like that. I'm not going to cover them today because they're stuff that you would usually use in stocks. But the idea between the risk-reward ratio is that the size of the average loss to the size of the average win of the trading system. So you can see that as a calculation that I've got there on the screen for you now. But as an example, if a trading system has a take profit of say 20 pips and a stop loss of 10 pips, then your risk reward ratio is going to be 10 to 20 or 1 to 2, which would make it a 0.5%. If a trading system has a take profit of 10 pips but a stop loss of 100 pips, then your risk reward is going to be 100 to 1 or 10%. If the trading system has a profit of 20 pips and a stop loss of 20 pips, then you've got a 1 as the number. So it's going to be just literally 1 because 20 to 20 equals 1 in ratios and your fractions, if you remember from school. So this statistic tells us whether the trades accept larger losses over smaller wins or vice versa, but it does not let us sort of form an opinion about whether the trader's approach is going to be profitable. When we sort of combine the two together, and this is something that by using both the win rate and the risk reward, it's possible to start forming an opinion about whether a trading system is likely to be profitable. So if you're new to trading or you're starting to build your own trading strategies, this will be important for you. In the idea behind it, if you have a win rate that is, say, I'm just going to move it to a table so you can see what I'm talking about. So if you have a win rate and a risk reward that one that's desirable, then you're going to sort of try and have an idea about where those percentages might be. So for the following table I've got here, it shows several different win rates along with the risk reward that is required for the system to have a break-even outcome. The third column extends this a little bit and shows the risk reward values that the system needs to be profitable. So by looking at the chart, you'll be able to see that if the win rate is 33%, the break-even point is going to be a 1 to 2 ratio, and that your system is going to be profitable if you have it less than 0.5. And if you obviously have it above that, then you're going to see other things as well. Now, in these examples, I should make it clear enough that knowing only the win rate or only the risk reward ratio is really not enough to be predicting the outcome of the system. If both are paired together, the information becomes a little bit more useful. And naturally, if we have a few other series of calculations and or percentages and ratios that we use, and ones that we get given or we're able to assess with, then we can get more information out of it. And the more information, the more data we have, the better it's going to be. So when it then comes down to pairing it with the idea of consecutive losses, the number of losses that we record shows how many losing trades obviously occur in a row. So small numbers tend to be better, especially if you're looking at it from an investor's perspective. And it provides a measure of likely size of account drawdowns as well. So by that state, if we have a number of losses in a row, then we're likely going to be able to see how far this person or this strategy will run us into the red before turning a profit around. So the win rate can give us the impression that there is a nice even distribution of wins and losses, but it's not always the case. And winning and losing streaks can occur, and they do tend to have a significant impact on trading outcomes or the curve that you're looking at. So during a losing streak, the account will go backwards, and knowing the maximum amount of recorded consecutive losses allows us as the traders to make predictions about how big our drawdown might get if it's a strategy we've developed, or if we're looking at a system or someone else's to trade for us, then we'd be looking at it from a very different perspective as the investor. So if you're using a strategy where trade size increases following losses, it's crucial to know the maximum number of losses you might experience. If you don't know this statistic or you don't take account of it, the chance that your account will be destroyed by a losing streak gets much, much higher. Now, the next one is the largest loss. And this is one that, when you think about it, it provides additional information about the drawdown potential of a single trade. So the previous examples we talked about the idea of a fixed take profit and a stop loss. However, a lot of traders tend to vary that stop loss and the take profit to account for different market conditions. And I am guilty of doing this myself, because if I don't see the market conditions fitting, then I will modify what I'm doing on the given day. And if you've been to some of my webinars before or watched some of my videos, I tend not actually to even use a given strategy or paper trading plan, as I just sort of wing it a lot of the time. But I did in the past, and that has sort of developed into part of how I trade now. And I have a lot of things that I just do automatically and don't need the sort of piece of paper to remind me. But it's always good, if you're new to trading, to keep that piece of paper by your side as a trading plan. But it measures to sort of provide insight into how it can happen and what the impact on our trading account might be. It also adds to the idea of what the average loss value might be in reports. So if you get out a printing report and you wanted to go to an investor to get funds, then usually they will ask you what your consecutive loss is, what your largest loss is, what your largest win is, and then they'll sort of work out from there what the average loss might be. And it's possible to average out a loss to be lower than the regular, because you get one large one, and then you have a consecutive series of number ones. Now, from there, we sort of talk about the idea of sort of the largest win, which I just mentioned before. Having the largest wins helps you to identify how typical, just like the opposite of your largest loss, what the typical average win is going to be. So if the largest win is a lot larger than the average, the largest win is a lot larger than the average loss, it may have contributed more to the overall result than the average suggests. And this may not always be a negative result, but some traders rely on outlier trades to boost the results a bit, especially if they're a little bit vulnerable with their trading system. So if a trade method relies on outliers to make profits, and it's missing even just one of the trade opportunities can make a big difference to the overall profits on trades, then it is likely a strategy you would not want to employ. Now, when we move on to that, we then go into a little bit more statistical. I promise you, all the mathematical and statistics stuff won't last too long. I'm going to try and get through it as quick as possible, and then we'll move into the stuff that actually will be something you can put in a practical sense of ideas. Now, when it comes to sample size, it's not often discussed, but without it, you can't make an assessment about whether the other statistics are valid. If the sample size is small, then the other statistics have doubtful value. So for example, if you have a small sample size of 5 trades and all 5 trades were winners, you can't declare that the win rate of your system is 100%. Because as the sample size increases, perhaps to 100 trades, you might find out that that win rate was really only 40%, and you're in a point in time in price where the system just worked well. And this tends to happen because trades don't always occur in neatly organized packages. There are winning and losing streaks, and in the example I've just given, the initial 5 trades may have been a part of the winning streak side of things. So the question to how big of a sample size should I be doing is really a hard question to answer, because the market's behavior itself is never uniform. And with all the volatility we've had now, and specifically pre-2008, we've seen the market behave differently after almost every single recession, and a new normal is sort of identified. If it moves into a different pattern depending on the various situations driving prices around, and as a generalization, you should have a minimum of 200 pieces of data roughly, and preferably a lot more if you can, just before you start beginning to form opinions about your trading processes. So if I was going to be running a new trading strategy that may be automated, or even if I was doing it manually and it was pattern recognition, and this applies more to the technical side of things, then I'd be looking at doing well over 1,000 tests to see how many trades really worked. These days, I tend not to trade that way. I do have automated stuff that I use, but it's not always the same. So, but either way, that frequency of trading can impact it. So a trader who trades on, say, a 5-minute chart might place 10 trades a day, and it will take them less than maybe a month to have 200 trades to be able to develop that data to start working with. Whereas someone like myself, who's a trader who uses 4-hour and daily charts, I might only take 2 trades a week at maximum. You can't make an assessment about whether other statistics are valid. So if you had a sample size of 5 trades and all 5 trades were winners, you can't declare that to be the win rate of your system as being 100%, because the very next string could end up being a sample of losses. So we really need to have between 200 and 1,000, if not more than 1,000, before we can start declaring what has gone on during our trading. So the next bit to sort of think about is our actual trade size management. And trade size management can be done in two different ways with calculations. The potential profit of the trade is the function of the size of the trade and the number of pips the trade moves before being closed. The potential of loss of the trade is a function of the size of the trade and the number of pips the trade moves before you actually close it. So these both of these sort of statements are expressed in the following equations that you're seeing on screen. Your max risk equals the max distance to your stop loss in pips times the value of 1 pip per contract times the number of contracts. And vice versa, the potential profit equals distance to take profit in pips times the value of 1 pip to the value of number of contracts. So to put this in a bit of context for you, I do have a chart to bring up with you, but I am just sort of going to go through it a bit simply before we move on to the other stuff. So for example, I want you to consider the idea of a trade on the euro dollar, where 1 pip of movement is worth $10 per pip or contract, or one standard lot. You have a stop loss of 20 pips and a take profit of 50 pips. Now, if you were to sort of think of that, then the contract sizes will, and the risk that you have for variance will be incorporated into this table that I've made up for you. So in one contract, or 1.0, you're risking $200 and the potential profit is 500. Now, if you were to then do the same thing again, you're for 2 contracts and it incrementally increases. And eventually at 5 contracts, we're seeing a risk of $1,000 for that same 10 pip stop loss, but the potential profit of 2,500 for the 20 pip take profit. So then I want you to sort of take into consideration that you have a $10,000 trading account. Now, by rule of thumb, the maximum size trade you can really take for a standard one lot for a $10,000 standard account would be about 1 contract. And so when we sort of start going up in numbers, let's say you've got $100,000 in your trading account or more, you're talking about having an account risk of 1 contract. You wouldn't trade any larger than that as the way you go up. And you can see why in this table. If you had a $10,000 account with 5 contracts, for it to move 1 pip, you're risking sort of 10% of your account. So this means that the trade plan needs to consider what level of risk is appropriate for the account and the plan for the trade sizes based off that. Not only that, you also need to take into consideration your own risk tolerances and how much you're willing to sort of consider. So when we then move into the idea of stop loss sizes, we need to sort of consider the stop loss size itself versus the minimum allowable size of a trade. So the value of loss equals your stop loss size in pips times the value of 1 pip times the size of your trade in the number of contracts. If we then rearrange those variables, we get the size of the trade that we're really allowed to actually use for that account type. So that's the second equation that I've got there below. So because of that, the stop loss size will vary according to the style of trading that you're using. Your short-term trading will use smaller stop losses, while your longer-term trading ends up using larger stop losses. So by example, if we were considering that euro dollar chart before, if I was on a daily chart, I would use a stop loss of 200 pips or more. And in fact, today I've actually placed one with 600 pips on the euro pound. And I have reduced my trade size dramatically. So as opposed to the normal size, it's about 10 times less than what it usually would be. So in that figure, if you were then to put it onto a 5-minute, you might only be using a stop of 10 to 20 pips, but it would often be much more appropriate at that size. So no matter how big your stop loss is in terms of pips or distance or the dollar value of the loss, it will be proportional to the size of the trade. Now, by example, I want you to consider trading a trader using a $10,000 account, and wanting to limit the risk by 1% or $100. So if you were trading euro dollar on daily charts, it's likely that stop loss will be in the order of 200 pips or more. So your position sizing would have to be, for the $100, to be $10 per contract times 200 pips, which then equals 0.05 contracts for it to actually fit into that parameter. Now, if you were trading the euro dollar on a 5-minute chart, it's likely that the stop loss will obviously be smaller. So I'm using, say, 10 pips as an example. And at that point there, for the $100 return and a 10 pip contract, you now are able to take a full size standard lot. And this sort of gives the idea that position size and the distance to the stop loss actually work together. There is a relationship between the two. And different trading strategies will require you to do this calculation to work out the difference between them. The next issue you sort of need to consider is what the minimum size trade might be for the account and what you're actually trading. Different brokers do tend to have minimum trade sizes. So for example, futures brokers often have a minimum trade size of 1 full-size contract or 1 standard lot, whilst most Forex brokers will have their standard minimum to be 0.01. So you can also then find micro contracts at some brokers, which are 1,000 times smaller. So your minimum contract size, whilst it's 0.01, it's 0.01 of 1,000 as opposed to 100, and makes your actual contracts 0.00001 of a full-size contract. So therefore, this is it's something you need to be aware of. You need to find out from your broker what you're using. In our instance at ACY, if you are trading with us, then it's 0.01 for you to be using. Now, summarizing it a little bit, it's not enough to just have a strategy for trading. It's important to know whether the account you're using can support the trading methods you want to use. So this is obviously going to involve calculating the level of risk you're prepared to take with your account, determining the size of the stop loss in pips based on your trading methodology, calculating your position size based on the stop loss and your risk levels, confirming that the stop loss you intend to use is less than the maximum stop loss your account can support. And if the account can't support the trading methodology you want to use, it may be possible to use your strategy by using a different type of account that allows smaller trade sizes, like those mini or micro lots I was talking about. So moving on to the next bit, we're going to talk a little bit about losses. Now, pardon me, sorry. Recovering from losses. For most people starting out, it seems like if you lose a trade, then you win a trade, you'll be back to neutral again. However, this is not really the case, because if you calculate your trade size from the bottom and keeping in mind that you can actually compound your account size from a loss is generally followed by a reduction in the size of your account, and therefore your next trade size needs to be calculated. It should be smaller, but the amount to recover from the loss is also proportionately greater. Now, if a loss of any sort of type, let's say, for example, you would have a 10% loss off a $10,000 account. So that means you've lost $1,000 and your account balance is now $9,000. In order to recuperate that $1,000 using the same sort of 10 pip stop loss, 20 pip take profit, you would need to be having your account, your next position size to be 11.1% as opposed to the 10%. So you do need to start increasing those sizes as you go up if you are trying to cover your previous losses. If a loss of any amount requires you to have that larger gain to recover from, e.g. the 10% loss I just spoke about, and it requiring an 11.1% sort of amount to recover that loss, a single or even a small loss amounting to 1% may not have a large impact on the process. However, having a series of those small 1% losses can build up the drawdown enough for it to have an impact. And alternatively, if the trade sizes are larger so that the risk level of each trade is higher, it becomes much more important and the factor increases. So how do we consider managing our stops? Well, a stop loss is an order placed with a broker, so that when price moves to that price, the position is naturally closed. The purpose of the stop is to really limit your risk and when price moves against the open trade. So when you are long position, a buy order is usually entered, then the stop loss will be a sell order to get you out. and vice versa. If you've got a short position or a sell order, then your stop loss will be a buy order to put you back at, take you out of the market. If the stop loss is triggered, your open drawdown becomes a realized loss. It's converted to a closed trade, and then your new balance becomes evident. We usually look at the idea of realized loss being, if you haven't closed a position, it's not something that's going to affect your account balance other than your drawdown factor so far. So, but there is the possibility for a stop loss to fail. So when traders set up a stop loss and it's hit, people are often surprised the loss is larger than they expected. And this is normal, and it's caused by the need for another trader to be available on the other side of the transaction at the exact same price. So when you see a run on the market like we've seen recently with the S&P 500 and a variety of other markets where we see price move very quickly and dramatically down, it's because there's no one on the other side willing to buy at that point in time, and you might not get out of your position for a little bit longer. The variance often is only very small, but in fast-moving markets like we've just experienced, from a few pips to even 100 pip or more, that factor can be attributed down to what you consider slippage. Occasionally, the market sometimes moves a long way in that one direction, and in this situation, there's really only buyers or sellers in the market and not both of them operating at the same time. So you have to consider that as a scenario that occurs. One of those occasions where the scenario occurs and the market suddenly reacts by selling aggressively was actually during the time that we saw with the Swiss National Bank. So a real life example is in January 2015, the Swiss National Bank unexpectedly announced that they would immediately reverse the policy by actively buying Euro Chef, and if the Euro Chef came overvalued. And as a result of that, the Euro Chef immediately fell like 2,000 points. And by the time of the announcement, price was so far down that some traders were positioning themselves to sort of buy into it. And it was only up until that point that it was expected. So to buy the Euro Chef to try and push the price up again, but because the SNB had made this announcement, price fell so fast within seconds that only sellers were in the market willing to actually sell positions. No one was willing to buy. So anyone who was holding a long position or a buy position was helpless to do anything about it. And price didn't actually return. It ended up being 3,000 pips lower. But by this time, the losses were massive. And many traders had obviously large losses, but they also had sometimes negative balances. And an even more sort of sobering event of that, a number of brokerages such as Alpari actually became insolvent and clients kind of lost money. So after that occasion occurred, we had a lot of people sort of move to a different way of trading, and we saw brokers implementing strategies to try and prevent that from ever happening again. Now, there are a number of different ways to place a stop. There is a hard stop, a soft stop, a disaster stop, and a variety of different trailing stops. A fixed hard stop loss can be placed at the exact time, at the time that you actually place a trade. It does not move for the life of the trade, which means that it can be opened and left without supervision. So this would be if you've watched some of my trades, maybe dealing with a double top pattern or pattern sort of thing where you're going counter trend trade. And I will use a fixed risk reward ratio and plugging in a stop loss and a take profit to fit in with that. So using that, because you've got an idea of what your risk reward ratio is, so in many instances it might be a 10 pip risk side and a reward ratio of 20 pip, then you would operate it in that sort of way. And once you set it, you can kind of forget about it. Now, the next type of stop loss being that soft stop or the fixed soft stop loss is a stop loss where price has to close over your stop. So in the fixed version before the hard stop, price just has to touch your stop loss to take you out. In the soft stop, price has to close over the stop loss before it's activated. So if price moves during a single candle and say it goes past your stop line but doesn't close there, it comes back down, then the trade won't close unless price is over that stop loss when the candle closes. It prevents stop losses from being sort of touched in closing, and it's not always demonstrated that can be demonstrated in a change of trend, but it's shown that where a stop loss is placed just above a previous swing high with a take profit just before the swing low, price tends to move back and over that sort of point, and in some strategies that's a problem. And it sort of allows price to move back down without closing with that sort of hard stop mentality. And you can sometimes turn a position around using a soft stop as opposed to the other, and vice versa. It's double-edged sword. If you were to use it the other way around, then you may have ended up without getting your position back to a profitable side. So it can be a positive outcome, can be a negative outcome. I personally tend to prefer to just use a hard stop, because then you're definitive about where it goes, and it gives you less chance of having increased slippage for a large move unexpectedly coming from a news event that occurs. The next one is a disaster stop, and a disaster stop is something that you might consider using if you are trading much longer term charts. The purpose of that disaster stop is obviously to prevent loss in the event of a significant unexpected price move. So it functions as a hard stop, but it's set much further away from price action than normal. And you can use it in a variety of situations. So alongside, like, let's say you had a soft stop where you had that, that idea of the price needed to close below your stop loss before it activated. If price all of a sudden moved way too far unexpectedly, and then you had your disaster stop behind it, then that's just sort of, your insurance or your guarantee that it's not going to let you go too much further. Then you can have it with sort of short-term trading and your scalping, and you can use it to rely on manually opening and closing your trades. So if you're someone who likes your scalping, you'll quite often find that you won't run a stop loss. You'll just have a set disaster stop, so that if price gets away from you and you can't get your fill to occur, or you can't click the button fast enough and price moves too quickly for you to get out of a position whilst you're scalping, then that's where another benefit of it being there to help sort of prevent you from getting more. You'll also find that fundamental traders, like, part of what I do, they will sometimes trade without a nearby stop because they're not focused on the technical side of things as much, if at all, in some instances, and they'll have a really strong conviction about which direction the market might be going in. So that stop loss will be placed a long distance away, just like my example before, where I've got, a target of sort of a stop loss of about 600 pips. So that's my disaster stop. I'm putting that right at the very back to go, this is as far as I'm ever going, because I believe price is going to move in the right direction for me. Now, the next types that we move into are trailing stops. And trailing stops have a variety of different examples. But the idea is that with a trailing stop, you're moving it along behind your price as it advances. So when price begins to retrace, the stop loss remains firm. But then if price moves back far enough, that stop loss is then triggered and the trade is closed. So this type of stop provides a way for the risk of the trade to be reduced significantly as the trade moves in your desired direction. So after a period of time, you may not even need to use a take profit for these, because as you trail your stop down in price, it'll hit your stop loss and take you out on its own. So you can use them in that sort of way. The rationale allows it to run as long as possible. So if you were to say, find a position where you had a pattern that you thought this is a reversal for a trend, then you would place that trade and hopefully let it run all the way down. It's an effective strategy. It can maximize that profit in some situations, but in others it might, take you out. So the compromises of it are that in a ranging market, trailing stops often prove ineffective because it's just bouncing price chopping back and forth too quickly, and it's sort of consolidation. And it sort of doesn't allow for the idea of running a trailing stop all that well. In other instances, if the stop loss is a long distance away from where current price action is, it's really not that effective. But it's risky sort of play when you use a trailing stop, and I prefer to use them because it kind of allows you to control that profit a little bit better, and allows you to set them nice and tight to where your entry is as well. So if it is close to price, it does potentially reduce the size of your loss, but it also means that if you have a retracement, it can sort of trigger a closure occasionally when you don't want it to. But nonetheless, some of the variants that I've got on here, I've got another chart for you to have a look at. And so I know this is a bad quality picture, but this is one that I've actually taken a screenshot out of my book that I've written. And this is what we call an ATR stop. And an ATR stop indicator is something that you can use instead of the placement of instead of the location of a stop loss. So instead of using a stop loss at all, you can use stuff like moving averages and other things along the way to sort of use that as your reference point. So in the instance that you've got on the screen in front of you, you can see that we have a variety of different ones. And the green one on the bottom, the green line on the bottom, the green ATR, is what I would have used in this instance or for this trading environment here that I've got behind me as a way of getting out of a position in an uptrend. It gives you a little bit more freedom to sort of, for price to move around. You can set the settings to be further or closer away to where price is. And by extension, you know, they tend to not give as much profit back, but it often can prevent a trade from achieving its maximum profits when you get a bit of a spike or a move down, which is something that plays out over when you would use a trailing stop. So when you have that, it's something you can use. The other instances of blue and red and pink lines that you can see on the chart in front of you of the ATR stop are things that they're exactly the same. They're just with slightly tighter settings. So you might use the blue line as a stop loss if you were scalping, but whilst the green one would be that if you were doing more swing trading sort of stuff. And that's just a little way that you can do it. Now, very much similar to that, you have the idea of using just a simple moving average. And the moving average can be used as that stop loss. If your trade is running and then it crosses over a clear point on your line, then you can close that position. And you can always automate these sort of things. So in this example I've got on the chart, the long green arrow is where a trade has been entered. And the stop loss line has been occurring along the way. But until price closes below it and what's been coded up, you wouldn't have seen price actually close in the trade end until where that little red circle is. But it is something to consider if you wanted to take a little bit of the guesswork out of your trading, automating things or using a different variance of stop loss as opposed to having to pick where price is going. You can certainly use methods like this to do so instead. And it just takes that fraction of a second that you might need for your mind to sort of think about your trading decisions. This removes a little bit of that. So it is another option for you all to consider. Now, using the idea of support and resistance is effectively how I trade with a trailing stop. And that doesn't make too much of a difference to me whether I'm trading from a fundamental perspective or if I'm trading from a technical perspective. I tend to prefer to almost always use a trailing stop, and I will do exactly this. I will move price down or up in this instance to each of my swing lows where suitable. And if I think that price is too close in one instance, then I will back it to the previous swing low or just simply not move it. So in this instance, you can use your support and resistance levels that are defined by your recent swing highs and swing lows, and provided they are going in the same direction as the market. So if you're doing that, keep an eye on what's going on. It does mean it's a little bit more intensive and you have to be paying attention much more vigorously, which is why I tend to trade longer time frame charts, because you don't get as much change over an hour or a 4-hour or a daily chart as you would on much shorter time frames. Now, the next bit that you can use is actually about the money management side of things. And I'm just going to give you a bit of a preference on some of the strategies that I use and have been used in the past. I'm not sure if you've all heard of Martingale, but the system of Martingale was actually developed by a casino player back in the 18th century. And he realized that if a loss followed by a win, if a loss is followed by a win, and by doubling that bet on after the loss, then you would be covering your position effectively. And you'd end up delivering a win that you were meant to win on the bet that you were meant to have won on the very first go. And people have used it in the past to try and apply it to trading. Unfortunately, it's one of those strategies you need really, really deep pockets, and you can't use it as much anymore, but it is still valid. But the concept and something for you to sort of consider is that, and how it works is, if you were betting on say for example a coin, that it's going to be a heads in a coin toss, and a $10 bet returns a $10 profit, the first coin toss is tails, so the $10 is lost. The second toss is heads, and the bet is won, and you receive a $20 profit. Over the two bets then, you lost $10 on the first but made $20 on the second, so then you get a net profit of $10 across the board. So while that example sort of demonstrates that by increasing your betting size after a loss compensates for an earlier loss, it makes sense from it mathematically, but certainly it's very much a gamble and that sort of thing, and you will never find this sort of strategy being operated in a lot in quantitative sort of places. So casinos actually became aware of the method, and they started introducing table limits to sort of prevent people using it successfully, at least. And for example, on a table which had a $10 minimum bet and a $100 maximum, then once you keep on increasing dramatically, a gambler who loses 3 times will have a following bet of about $80. But if that next loss loses, it goes to 160, and you incrementally keep on increasing. As you can see on this left-hand side of the chart, by the time you've had 10 losses, you're now in a $10,000 bet. Now, if we were to apply that to your trade sizes, you can see how quickly your positions get tallied up from 0.01. You're starting at pretty much the smallest size you can do, and eventually you end up at very large trading sizes. So the question now and then becomes, how likely is a trader likely to experience 10 losses in a row? And pre-2008, you could actually answer that question with statistical evidence, and you could turn around and say 11 times is the maximum time you'll actually lose in a row if you were to do it with grid trading. So one of those sort of statistics was, that maximum number of consecutive losses, and how this value would be helpful in determining the risk of a system and it becoming too large to sort of support. Even armed with the statistics, it would still be possible for a number of consecutive losses to go higher in the future. And if we use the idea of 3,000 point move in one direction, you can imagine how big the losses would have been for you to be able to actually turn this around. So even though the approach doesn't seem attractive because it avoids losses, there is a risk you won't be able to sort of sustain it. This means that that sort of desire to avoid loss will be converted into a very large realized loss very quickly and easily. So it would mean sort of then that, your risk potential goes up very, very significantly and much faster than you would hopefully anticipate. Now, I mentioned the idea of grid trading with Martingale. And this was a strategy that was used by a number of institutions in the US at one stage when I was over there. And it sort of follows an idea that you are using Martingale. So at each of these dotted blue lines that you can see on the screen, you would have a scheduled entry. And between each of these blue lines, you'd have a certain distance allocated between them. So for argument's sake on this one, I'm going to say 30 pip as each line has 30 pip in between it. And the idea behind this is that, when you do use a scale or grid, its greatest strength is that it relies on the money management to make a profit, not actually your entry. In grid trading, it really doesn't care whether you enter long or short. It just, at the core, it's a trading version of Martingale money management. And it carries all the same benefits and the appeal, meaning that every time you lose, you can make your money back, but it also comes with much of the same problems. So grid trading works really, really well if price is moving in a range or it's consolidated. And I still use some stuff that I've coded and made over the years that do employ this, but only during a place where I identify it to be worthwhile using. So whilst it's in a normal trending period or trending phase of the market and retracement, it's not something I like to employ, because the chances of it running in the wrong direction for far too long and emptying out your account balance is very, very high. So where it makes its money is actually based on the retracement side. So if you entered a position at, say, point A and then it went up to and clicked off at point B, you would want price to come down from point B back to point A, and that's where you recover your money. If it doesn't make that full 30 pip retracement, then you're still stuck in a position, and probably with a larger lot size than you would actually want to use. It really relies on that idea and the fundamentals behind it, that as far as price moves away, it will eventually retrace, which is true. And pre-2008, you could turn around and say that if you were running 30 pip levels with a guarantee, you would see price move no more than 11 levels or 330 pip without a 30 pip retracement. And this is what a lot of funds actually did to do it. Now, whilst doing that, obviously 2008 happened and they saw 400 pips wipe off the board in an instant without a single retracement. And a lot of people who had positioned their accounts to set up for that lost a lot of money. Then, of course, you had 2015 where we saw 3,000 pip move. And that has basically wiped out any concept of this being effective in a trending environment. In a sideways environment, you can set this up on a much smaller scale using 5 or 10 pip increments in a range of, say, 100 pip, and let it run back and forth in between it. And anytime it goes outside of that range, you turn off or stop trading in a range-bound way. It is very intensive. It is mathematically driven, but it is something that you might be able to take advantage of if you would decide to have that focus with it. Now, to run through this chart in front of you a bit, I've just sort of marked out and I've written it down as to how it sort of plays out. So at A, you make a sell entry. And for the sake of the example, let's say it was a 1 contract trade. There's no reason for going short at this point, but it could have been, and it could easily have been a buy. At point B, prices moved backwards, say 100 pip without reaching the 100 pip goal. So now another sell entry is open. This time, instead of being for 1 contract, it's now 2 contracts. And this is the point where the open profit should be negative $1,000. At C, price has moved back another 100 pip, and another new sell will be opened. This time it's 4 contracts. Each time you're doubling as you go along. And now your open position will be negative $4,000. At D, price has moved back another 100 pip, and now another sell is put on, and this time it's for 8 contracts. As it keeps going, now you're negative $11,000 in unrealized loss. At point E, it occurs again. You're now at 16 lots in total with a $26,000 position that is open. At point F, price finally turns around for you, and it comes back the 100 pip, and you allow all trades to close at that point. It's at that point there, your profit will be $5,000 at point F. But if you were to allow that to go one more level down to, say, where point C started and go for the full 200 pip down, you effectively nearly double your bank account size, and very quickly at that point. So at the worst point, your drawdown was 5 times larger than what the profit would be if you didn't let it go the second level. And I wouldn't ever consider it to be a safe approach, and I wouldn't advocate to you to do it. But if a trader does decide to use grid trading, then it's worth knowing that different markets move differently. Some are more prone to fast movements. Some are more prone to consolidation. If the approach is used, it would not make sense to sort of use it with markets that trend strongly. And it's important to sort of accept that even though 90% of the time the strategy will work and not cause problems and generate a return, it'll be that one time, and that it does, and it's imperative that there is a pre-planned approach to deal with these sort of eventualities. Whether that means you hedge a position to try and control the loss and sort of balance out your margin is one way, but it is something that I have used them in the past, and I do it with different ways nowadays. But I only ever focus on trying to trade something like this when there is almost no market action and it is sideways, because you're not going to make money anyway, right? So might as well give it a go. Now, the next one, and the reason I sort of went through the idea of grid trading for you, is more so about talking about this next slide, which is pyramiding. And this will be the last slide we cover tonight, and we'll start wrapping it up. I understand that I'm sort of a bit over time because I had sort of internet difficulties before, but Pyramiding is the opposite of scaling in or using grid trading. It involves creating additional positions in a losing trade, which is what you get when you sort of scale in or you're using or grid side. You're adding additional positions to your losing trade. But in pyramiding, it involves creating additional positions in a winning trade. So the rationale is that if the market has become favorable, then it makes sense to sort of load as much on your trade as possible to improve the outcome. This way, the trade can benefit from having a large position size, provided the stops are in place and the risk is reduced. So in the drawing I've got on here for you, at point A sell has been opened. There'll be a stop loss behind that, defining the opening of risk. Price moves in the favor down that we like. At point B, trade at A is in profit. The stop loss was moved down to break even to make sure that you're not at any more risk at that point. And there is a downtrend running. And so instead of enclosing trade A, we add another trade for the same amount. And then we put another stop loss in behind for that trade, and we define the risk of that trade as well. At point C, both trade and point B are now in profit, and we move both stop losses for them to be at the same point, somewhere likely where it's either going to be break even for point C or even potentially profitable. So when we move it to that next bit, we're moving it through swing lows and trailing our stops down. Trade B has now become effectively a risk-free trade. And trade A has also become, is only profit now because you've moved your stop loss past it. The trade is satisfied with that sort of side of things. You continue to add new sells and you keep going again. So now you've got 3 trades in total at point C, and you've got 2 of them with basically locked in guaranteed profit regardless of what goes on, and you can't do any more harm to it. So even if it hits break even, it's on trade on trade C, your third one, it's not going to matter too much. Now, once you've recognized that that next trade has been opened, you've got a defined stop loss again for the C trade, then you now move down. Then we move down and price moves on to point D. We moved our stop to another low, and we have another opportunity to sell again at point D. This time, however, price moves a little bit higher and breaks the entry of trade D, which represents a new swing high. So this means now trade D is going to be for a loss, but trade A, B, and C are all going to be for a profit, and they hit the stop loss and close off all of our positions at the same time. By doing this, pyramiding reduces the risks that, in a diagrammatic trade that's occurred at the first time of the trade. For the sake of discussion, it's going to assume that each trade is one contract. The stop loss was going to be 30 pip, and each leg achieves 30 pip on the way down. So when you're using it, it's going to be profitable. It sort of reduces the overall amount of risk that you have, and you're reducing your risk as you go down. And it allows you to sort of find where the turn might be. If pyramiding is going to be used, and you were to carry sort of some risk behind it, it still isn't going to affect you too much when it comes to it. But either way, you need to be sort of considering the account sizes of itself and what the risk might be and what your own risks are going to be at the end of the day. So I'm hoping that tonight you've had a bit of a good experience. I know the dropout of internet is been a little bit difficult, and at the moment we're probably going to see a little bit more of that occur. I will see if I can find a workaround, but purely because we have so many people starting to work from home with lockdown here in Australia, bandwidths are not as perfect as we would like them to be. So for you guys to have a little bit of a think about and to maybe do some more exploration on your own, do some simple calculations, maybe start with a $10,000 and then reduce it by 10%. Then calculate what sort of percentage of gain might be required to make the $10,000 back. Repeat the process a few times with, say, 20, 30, 50% reductions, and then have a look and try and understand what that percentage gain might be to return the account back to its original state. Another way to do it is to sort of identify a chart Or another thing I'd like you to do is sort of open up a chart and identify an area where price is moving in maybe an uptrend or a downtrend, and locate a peak and notionally enter a one contract trade at that point in time. Probably do it on a demo. If you want to do it live, feel free. And since you've sort of entered at a peak, I then want you to identify the next trough and imagine that you entered another position at this point and calculate where the average entry point might be for both trades and calculate what price the trade would move back into a break even or better position. And this sort of stuff will help you to sort of manage your money when it comes to actual trade sizes themselves. And of course, some of the strategies that you've seen here tonight will be beneficial in how you might think about structuring your trading plans as well. So does anyone have any questions at this stage or something that I can sort of speak about quickly? If you don't, then that's all fine. I understand it is late and I have run over time. So if you would like to end it, I have no issues with that. But of course, feel free to send me an email at talktoal@acy.com if you have any other questions that you might think of overnight as well.